the Fed fund rate. Now they're expecting that the Fed fund rate in 2025 is going to be at 3.4% versus 2.9% earlier. The change in real GDP is actually higher for this year. They're now talking about 2.5% versus 2%. But overall, PCE also remains sticky. Steve is with us right now, so let's take it across to him. Steve Englander, hi, good morning. Thanks so much for making time and speaking with us. To the point that it's now about 2 rate cuts and not really 4. And we have seen the reaction that we have seen in equity markets, dollar index and all of that. But how much of this do you think is now priced in, and how much do you think Street will take more time to digest all of this?
Hello.
Hi, Steve. Can you hear us?
Hello.
Okay, I think there is still a bit of an audio issue. Steve, hi, good morning. This is Anisha this side. We're talking about the Fed commentary and the hawkish tone coming in. What's your first takeaway?
I think the market expected some hawkishness, and that was priced in. But I think that the extent of the hawkishness was very unexpected. And I think the market expected a low vol FOMC, no surprises, a bit of a nudging of the dots. Instead, the inflation rate next year is 2.5%, way above target. The Fed cut back. It was very surprising in terms of the extent and commitment to hawkishness that we saw here.
Steve, but do you think this hawkish turn by Fed could really set cat amongst the pigeon, and it could lead to it could inject volatility in financial markets? Because the way financial markets today are melting, it means that there is a lot of apprehension on the glide path now.
Look, I think it's clear that the Fed intended to send a hawkish message to the market. Whether the economy is going to be as hot, whether inflation is going to stay up as high, whether the unemployment rate is going to stay as low as they predict, is a different question. We don't think so. We sort of think that the economy is going to be softer, and so they're going to end up cutting more. But it's clear that in the short term, the signal that the market is taking away is the signal that they wanted to send. The equity market is down by 3%. I don't think that is too meaningful right now from an FOMC viewpoint, given that S&P is was well over 6,000. But I think that if it continues to fall, it will be an issue. Overall, I think that maybe they were sending a signal to the Trump administration. Maybe they're concerned that inflation has nipped up a little bit. But again, the market is behaving as if their forecast is going to be the reality. We don't think that's the case. They may turn out to be right. We'll see.
Steve, so in terms of the way forward now, could this move from Fed trigger a fresh wave of buying in dollar index? And could we see rotation of flows back into US denominated assets? Because if the Fed will cut rates, logically it means bad news for emerging markets in the short term and good news for dollar denominated assets.
Yeah, look, I think that in this case, it really is data dependent. And we're not going to get the next payrolls till the 10th of January next year. So we have 3 weeks in which the only signal in the market is the Fed hawkishness. So I think we could see more follow through. Ultimately, we don't think the economy is as strong and inflation is as robust and the labor market is as tight as the Fed makes it out to be. But I think it will take a while for that to become the market consensus. So in the short term, we could have more dollar strength.
Really appreciate your time. Glad you could join us. Back to Mark.
If you like this video, then like, share and subscribe to ET Now.